Hello everyone, Nick Ragan here with Next Home. I had the question come up this week, how do I get rid of my private mortgage insurance? In other words, PMI. So there's a catch to it. So if you're a conventional buyer, let's just say you buy a house, you put 5% down, it's a conventional loan type, and your loan to value reaches 80%. Okay, so what the bank will utilize is if I bought a place, let's use an example for $200,000, and I put 5% down. 5% of 200,000 is $10,000. At $10,000, I utilize as my down payment. Bank sees that you're at 95% loan to value. But let's say that value goes up, okay? It goes up to 300,000. Okay, now the bank sees that you have more than 20% built in as equity. So at that time, that actual PMI would be erased. They can utilize an appraisal or a broker's price opinion. Usually they like to have an appraisal, and then they see that 80% loan to value, that 20% equity is built in. Now with FHA, it's a little bit different. So from 1991 to 2000, they put some rules and provisions in play that anybody after 2000 could not actually remove PMI if you're an FHA buyer until you paid in to 20% equity. So in other words, if I put 3.5% down, that's typical for FHA buyers, put 3.5% down, I would have to pay up until I got to 20% equity that I've paid into, not what the property's appreciated at. The other option is to refinance into a conventional and then remove that PMI if you're an FHA buyer. So I hope that makes sense. That's how you remove PMI at the end of the day. Thanks.